We got a ton to cover in this panel, so I'm just going to jump into it. I've been on stage here before. I'm Grant McCarty. I'm the co-founder of Bitcoin Policy Institute. This panel is not about me at all. I'm teeing everybody else up here, so I'm just going to throw it down the line. Nick, why don't you introduce yourself?
Hey all, I'm Nick Anthony. I'm a policy analyst at the CATO Institute Center for Monetary and Financial Alternatives. I'm also a fellow at the Human Rights Foundation, mostly covering cryptocurrencies, central bank digital currencies, and financial privacy.
Hi everyone, my name is Amena Ross. I'm the head of global policy for Cash App. We were mentioned earlier, and I'm just excited to be here.
Hello, my name is David Spencer. I'm a certified public accountant, owner of DKS Tax and Consulting. I serve digital asset investors and their businesses with implementation, tracking, and reporting.
My name is Abbassi. I'm founder and CEO of Hoseki. We're an asset verification platform with proof of reserves being an application of our business. Previously, I was at Fidelity where I worked on custody with a focus on proof of reserves and zero-knowledge encryption. And I had the privilege of being a co-author on the Practitioner's Guide for Proof of Reserves, sponsored by the Chamber of Digital Commerce.
And I'm Thomas Hogan. I'm a fellow at the American Institute for Economic Research and was formerly the chief economist of the Senate Banking Committee.
So we're going to start off pretty high level, name a bunch of different legislative issues that we're going to cover in this panel, and then we're going to dig into each of them. And so just going down the line one more time, what do you all consider, pretty concisely, high level, the most important legislative issues facing Bitcoin? And do you view those issues as challenges, or do you view them as potential opportunities for the industry?
So one huge challenge that's before all of us really shouldn't be a surprise, and it's something that Senator Cruz mentioned with the Infrastructure Act. That was now like 2 years ago or so, and while there was a huge pushback from the industry, from think tanks and the like, it still hasn't been fixed. There's been bills put on the table that could fix it, but there really hasn't been any movement. And between the broker provision and the 6050I reporting provision, it really is a mess, and it really could halt this industry in its tracks as far as the United States is concerned.
I would say that one of the biggest issues in the industry right now, and I would say that it's more of an opportunity, but the issue of debanking. And I think it's an opportunity because it gives us insight or perspective into where our regulators and policymakers are and their understanding of how this particular crypto asset works and what is the future for it. And I think it's an opportunity also because it really puts us on center stage with our global regulatory and policy-making colleagues as to whether or not we're going to allow adoption of this or be an obstacle to it here in America.
Again, as an everyday practitioner, I do people's taxes. So one of the things that I often see is how do we actually report information? So the one thing about the blockchain that we love is that I don't have to chase clients' data anymore. I don't have to call you 100 times and ask you for a particular form. But when I get to the blockchain, how do I provide reporting information that's necessary, like you touched on, when all I've got is blockchain data? I got all the numbers, but what's the name, the address, if you're giving to a not-for-profit, right? So I see a lot of really nuts and bolts, nitty-gritty items, and how can we have common sense legislation that really gets all the way down to address that? All the way from miners negotiating with power companies to the customers whose miners are no longer working because that negotiation failed. So those are the things that I really like to talk about.
My thing is proof of reserves. I think it's an opportunity. I think it's obviously an opportunity. I think Bitcoin's most important characteristic is its auditability. It's completely auditable, and it can be done so by a private citizen independently, and that can't be said for any other form of money, not dollars, euros, yuan, or gold. I can do that from the comfort of my own home, and that's something that I think should be exploited as much as possible.
we've heard a couple times today that Bitcoin is not crypto. And I think that that is actually reflected in some of the important legislation right now. That I think the two biggest issues are legislation about stable coins and the definition of what is and is not a security. And we have pending legislation on both of those, so hopefully we'll see some action on that. But I think two other areas that would be interesting would be if we could have something that would prevent the Department of Energy or any kind of discrimination in terms of energy that's used for digital assets. And then also the regulatory overreach that we've seen in the last couple of months coming from the SEC and the bank regulators, it seems like there should be some pushback against that so that they can stay within their stated authority.
So let's stick with that theme of legislation versus regulation, because we just had the Bitcoin and regulation panel. And I think a lot of times these words, regulation, legislation, they just get thrown around, interchangeably, where I don't know. I think a lot of you in the room understand the difference, but for a lot of our audience, I'd like to dig into where is that line, right? Where does legislation differ from, what regulators can do, and then where are those fundamentally intertwined? So Thomas, I'd like to start with you. I believe your background, brought you to the Senate Banking Committee, and so I think you are, uniquely well qualified to talk about where legislators are coming from here and how that combines with what regulators do.
Right. So, we typically have legislation that is passed by Congress and then approved by the president, and that directs the regulators to write the specific rules and regulations. And so, an example like the Dodd-Frank Act required the regulators to write like hundreds, maybe thousands of different rules, and they have to get the detailed specifics of how those rules and regulations are going to work. And it's important because of the issue that I mentioned a minute ago about regulatory overreach that we're seeing right now. The regulators are supposed to go through the notice and comment process, that they put out a public statement, a notice of proposed rulemaking, and then they get feedback from the public, and then they issue a final rule after that. But what we've seen lately is instead of going through that process, they've just rewritten the rules or reinterpreted the way that they define the current regulations in order to really go after the banks and go after companies that they think are issuing unregistered securities. And so they've really taken a lot of discretion. I mean, the guidance that was recently issued by the Fed in January is a great example of this, where they just said, you can have crypto, but we might consider it to be very risky, right? And so we might penalize you for that, even though they didn't do any actual proposal. There's no clear interpretation of how the banks should understand that if they're taking more risk or they're being safe. It's also the case that the regulators, at least the financial regulators, don't really do any cost-benefit analysis. In some cases, they're supposed to be required to do that. But I wrote a paper reviewing 27 of the biggest capital regulations issued by the bank regulators in the last 40 years, and found that in 0 cases did they actually do a quantitative cost-benefit analysis. In some cases, they said, we believe the benefits exceed the cost, but if you read the details, they actually just say, well, there's really no evidence. And so this is particularly important for crypto because it's so unknown. We would want to see what the regulators think are the important costs and benefits so that as an industry we can challenge it if they're being unfair.
So it's interesting, right? Because the way you frame the regulation, and specifically you mentioned some of these comments that have come from the Fed, the OCC, the FDIC, specifically around banking and banking with Bitcoin and crypto companies, you seem to have a relatively negative tone on how that has taken place. And Amena and Sam, both of you actually described the legislative issues at hand actually as an opportunity. And I believe, Amena, you mentioned specifically the banking issue as an opportunity. So curious to hear from both of you, where do you differ from what Thomas just said? Or are you saying the same things, but this is, what's next for the industry?
Yeah, so I actually think that we're two sides of the same coin. I think that one of the great things about our system here is that it creates space for dialogue. And, the guidance that came out in January from the Fed, from other parts of the federal government, caused policymakers to say, well, wait, hold on. We have an opportunity here to give our thoughts on who exactly should be responsible for determining what kind of risk is associated with this particular asset or overall in the financial system at hand. So there were letters. Many of the regulators came in for Humphrey Hawkins hearings and other parts of the advising of the administrative branch. And it has led to some guidance and statements from the Fed, from other parts of the federal government. Treasury just put out guidance yesterday on de-risking. It didn't mention crypto, but I'll just leave that there. So I think there was pushback from the policy side of the equation, from the legislative side. And that has led to kind of a writing a little bit of how much the administrative branch can exert their authority in this space.
Yes, Sam, you mentioned proof of reserves, a potential opportunity, and I think this aligns really nicely to talk about what is the legislative opportunity there. Is that going to come from legislators or is that going to come from regulators, and what problem is that solving?
Well, I mean, ideally we would self-regulate. We just haven't done that thus far. It's always been a dance between demand and incentives. So there hasn't really historically been customer demand for proof of reserves. Customers of exchanges haven't asked their custodians to be transparent about their reserves. And as a result, exchanges haven't had an incentive to be transparent, and they would prefer to not be transparent if they could help it. So we're kind of at a point now where proof of reserves, funny enough, is kind of like a household name within the industry, which has never been the case. And I'm shocked to see that on Bloomberg News headlines. I never thought that would happen. I think it's an opportunity, though. So proof of reserves is auditing exchanges, which I think is a good thing. I think we all probably agree with that. And secondly, it's an opportunity because it redefines confidence and trust in an industry that historically has had neither. It's an opportunity because legislators can make meaningful change that will strengthen the industry. Regulators have something very straightforward to enforce. Exchanges and custodians will now have clear guidelines on how to conduct their operations, and customers, retail and institutional, will now have the confidence and the peace of mind to use these now compliant services. So I point to HB 1666 as a great example. That bill just passed the Texas House with a majority due in large part, if not entirely, to Lee Bratcher's efforts of the Texas Blockchain Council, along with a handful of industry experts. This bill requires digital asset exchanges in Texas to be compliant with the proof of reserves regime. And that's defined largely as two requirements. One is quarterly attestations, and two is annual attestations overseen by an auditor. So this is what moving in the right direction looks like. This is the right thing to do. And I know there are several other states that are interested in proposing a similar framework. I hope that my home state of Florida will pick up the baton next.
So you talk about guidelines. I mean, David, your job is all about guidelines and being given guidelines and told, hey, here are the rules to follow, and here are rules that you shouldn't break. What has your experience been in terms of those guidelines, and what would you be hoping to see to make your job, and by proxy, millions of Americans who own this technology and this asset, to make their lives a lot easier?
Well, first of all, this guy is awesome, right? When he's talking about auditing, when he's talking about proof of reserves, I love that, because that's what keeps me up at night, right? So when we see robust companies having clear guidance on how to use digital assets in their operations, how to track them and feel comfortable doing that, when there's tools available to make that happen, that's when people can really feel confident that we're building an industry, right? Because that's really what we're watching. We're watching the whole industry evolve. I learned so much from Jack just now. That was an amazing presentation about the infrastructure of what's going on behind the scenes. And if we look at it from that perspective, my job is really a referee, right? I want to make sure that the IRS is playing by the rules, and I want to make sure that we're all playing by the rules, right? But if the rules, A, don't make sense, right? So if I have to give you information that literally does not exist, okay? You want me to give you somebody's address when I'm looking at a blockchain transaction. OX, blah, blah, blah. That's all you got, okay? So if the rules are impossible to abide by, that's a problem. So that's why we want to talk to legislators and make sure we have common sense things going on. or if they're overly cumbersome, right? Because nobody's thought about what it's actually going to take to make this happen. And so that's why it's really important for us to engage and kind of see the whole chain of events for like the vertical integration, so that we can make sure that what we do at the top actually trickles down, so that by the time we enforce these items, they still make sense.
So Nick, David mentioned rules that don't make sense. And I know you have pretty strong opinions on a few rules that have been passed at a legislative level that you maybe don't think make a lot of sense. So why don't you walk us through a few of those?
So that's a really long list to start with. I'll keep it as short as I can for these purposes. I really like how you phrased that, David, because immediately I was thinking in my head the 60/50I and the broker provision. Because with 60/50I, the reporting that needs to be done between two individuals, I'm sure, and I'll go a little deeper in this in a second, I'm sure a lot of people in here are familiar with the third-party doctrine. And to have two individuals be forced to report on each other information they probably don't have is, at the very least, overly cumbersome. Now, making matters worse, we have a law that is also set to take forth where minors are going to be required to report on essentially anyone when they process a block. If there was a transaction in there, they need to report the social security number, address, and the like. And that is just impossible to comply with. That is such a ridiculous standard to put forth. And I really like the way that Senator Cruz described it earlier when he said that this was just thrown through. Because I can even go further and say it doesn't make sense for the justification. These provisions were pay-for provisions in the Infrastructure Act. They were supposed to raise revenue to offset some of the spending. And I looked at those numbers and I was like, this doesn't make sense. This is just way too high. And I tried to meet with the Joint Committee on Taxation, ask them what's going on there. Unfortunately, the rules that bind them say they really can't share their models. Well, fast forward 6 months later, the Biden administration releases its tax revenue projections. And you look at where it's looking at cryptocurrency and digital assets, all of a sudden, it's 10 times less than what was projected in the Infrastructure Act. So these rules wouldn't be taken out because they said, we need the money, we can't find another place to get the money, we need all of this revenue to come in to offset it. And then 6 months later, well, actually, we're not going to get even a tenth of what we thought. And sadly, that's a lot of what we're seeing here, just fundamental misunderstandings. Just really quickly, for those that don't know, the third-party doctrine that I mentioned, that was, we have privacy protected by the Fourth Amendment to the US Constitution. Unfortunately, the Supreme Court in the 1970s said, well, you have privacy unless you share your information with a third party. Then the government no longer needs a warrant to go after that information. Now, there's a ton I can go in with that, but what's really important to take away here is that self-hosting, self-custody, and decentralized cryptocurrencies, Bitcoin being the perfect example, makes a fundamental difference. Because if you remove the bank, you remove the intermediary, you're not holding it on a third-party wallet, you should be able to have that privacy for yourself. And yet we're seeing time and time again with the self-hosted wallet rule, with the legislation that with Elizabeth Warren, introduced last year and again this year, we're seeing this fundamental change where they're trying to say the third-party doctrine isn't good enough. We want to be able to surveil your individual transactions. And again, that just makes zero sense if we are maintaining that we have a constitution in this country, if we're maintaining that the Fourth Amendment is something that exists. And sadly, it's just becoming such a theme that all these laws are coming into place that just, or being proposed, that fundamentally do not make sense.
I think there's an interesting point too about privacy and how we discuss privacy. We talk about privacy almost like it's a four-letter word, right? Like, I want to have my privacy. But privacy has been a thing for a long time. We have every kind of trust you can imagine in the, right? There's all kinds of ways to protect assets. We've got offshore havens. We've got a number of different places where we can protect our assets and keep them private. So why is it a new big deal to say, I want my privacy now? Is that because people who aren't paying attorneys, $40,000, $50,000 to set up that trust, they can also have privacy, right? So privacy is something that we've always had. It's too bad it's getting a bad rap.
One quick point. I love that so much because I hate to be like looking at this from a negative perspective, but I think you're spot on because we see more people than ever before have access to privacy, have access to new financial tools. And all of a sudden we're seeing, oh no, that's we don't want that. We don't want you to have that. And it really goes back to, I think it was last summer or the summer before, when the proposal was floated to monitor bank accounts at $600. That was pushed back, but it was still maintained for if you use something like Venmo. And the justification was, we're going after the billionaires that are cheating taxes by monitoring.
At $600.
And that's just so hard to even take
And we
at
fell
face
for
value.
it. We fell for it. $600, I'm going to catch a billionaire with $600. What?
I mean, you can count them on two hands. Why do you need to look at essentially every American's account? It really doesn't make sense, except for the fact that all of a sudden we have a fundamental change where more people than ever before are having access to new tools and new opportunities. And there are some folks who just can't live with that, sadly.
We've hit on a couple interesting points. I think this brings to the forefront an issue that we brought up and made the framing of this entire conference, which is Bitcoin is unique among cryptocurrencies, and a through line of this entire event has also been Bitcoin is fundamentally different than anything else we've seen before. And Thomas, at the beginning of this, you mentioned that a lot of the issues that are being focused on from a legislative perspective actually are less Bitcoin specific, and multiple people on this panel have mentioned that some of the bills that we've been seeing seem to fundamentally misunderstand how this technology works. So Thomas, I wonder if you can walk us through what are the primary issues that Congress is worried about, and why doesn't that apply to Bitcoin?
Well, so as I mentioned, I think two of the big ones right now that we're seeing are what is the definition of a security and what is going to be the regulation surrounding stablecoin issuance. Is it going to be banks, non-banks? What are the rules around that? And so the securities definition, the regulators have basically admitted, this is definitely not a security, right? The previous panel was discussing this in more detail, but Gary Gensler of the SEC has said, okay, Bitcoin, not a security. Everything else in crypto, it might be, even stable coins, which seems like, how could that possibly be a security? And so, that's an issue where Bitcoin, I think, has already shown that it's different, right? It's decentralized, it's stable, it has now a long reputation that no other cryptocurrency has for being reliable. It's got a group of developers and people that are running the network that don't ever want it to change. We've seen multiple forks where there was arguments about should we change the code, should we try to improve this, and every single time people decide, no, we want to keep it how it is, right? And so it's got a reputation that it's proven to be reliable, and it's got really only one goal, that it's trying to be money. It's not trying to be everything else. A lot of the other smart contract technology, they want to be the foundation for a lot of other things that I think might be great opportunities, but those goals are fundamentally different than what Bitcoin is trying to do. And so I really think that in the way that it's designed, in the community that it has, in its history already so far, those things are just different than other cryptocurrencies, and the regulators are, acknowledging that.
And this makes me think about the FTX situation, where FTX had this exchange token, FTT token, and because they were the proprietary owners of this token, they were able to issue this token, print this token. They had all of this information about this token that wasn't necessarily public. And when we talk about legislation around securities, we think about Sam, to your point, auditability, and do we have visibility over these things? And if not, and if the properties of this technology suggest that it's effectively an unregistered security, then how is it fair that the people who print it, pardon my language, the people who issue, these new technologies have way more information than the consumers that they're asking to purchase this technology? That's a fundamental information imbalance. And so, Sam, if you want to continue the point on proof of reserves and how something like proof of reserves stops an FTX type situation in the future, and also why is Bitcoin a fundamental part of that? What about Bitcoin and what makes it different is a fundamental part of what you're doing?
So sort of tangential to that, FTX had 0 Bitcoin. Zero. They had no Bitcoin.
They said they had 86,000, or they were supposed to have 86,000.
On paper,
right?
yeah,
Okay.
someone typed that, but they had absolutely no Bitcoin. So even if proof of reserves isn't great, what's the saying? Perfect is the enemy of good. The liabilities is still sort of an unknown problem. We can still have transparency over the assets, and that would have, if not prevented an FTX systemic crisis from happening, it would have mitigated it at the very least. So I still think implementing some sort of transparent, auditable regime is really important. With respect to what makes Bitcoin different, I echo a lot of the same points as Thomas. I think it's 2 things really. So there's the form and the matter and the composition, and the composition is Bitcoin. The matter, materially, it was the first of all cryptos that was launched, which means 2 important things. One, it benefited from those couple years of development that no one was really paying attention to it. You had those early cypherpunks who were building this thing, iterating it. No one, including and most importantly, legislators and regulators, none of them were actually paying attention to it. Secondly, it never had the expectation of insane returns, something that no other crypto today could claim, or no other next generation blockchain could possibly claim. So that's the matter, the material thing. And then in form, the community is the most conservative of any community within the space. And that's very important, because when you are thinking about your savings and you're thinking about sound money, you want something that's robust. You want something that's fixed and something that's hard and that won't change. And of all of the cryptos that exist today, Bitcoin is the least likely to change at all.
By the way, by conservative, you mean fiscally conservative, or do you mean like politically? Okay, we'll table that question. If you saw an announcement earlier today, hopefully you see there is bipartisan nature to this technology. Amena, before we wrap up here, I want to ask you about your work specifically, and maybe talk a little bit about why your organization is Bitcoin first. What about Bitcoin made your company do that? This is a company that is providing financial services to tens of millions of Americans and people around the world. So why is Bitcoin part of your strategy?
So for those of you in the room who are not Cash App customers, I know there's at least one. I think it's very important as we broaden this conversation about Bitcoin to adoption by everyone, I think it's important that we talk about how other cryptos do not have the same protections that I think folks that have been disenfranchised by TradFi are looking for. The decentralized nature of Bitcoin, the fact that nobody gets to decide who can buy it, who can, transfer it, who can sell it, is actually a very big part of why women, people of color, individuals in other countries are so interested in the growth of this sector. And I think for us at Cash App and at Block, we wanted to provide folks an on-ramp to an industry that is a little difficult to understand. I mean, I think everyone in the room can acknowledge that. To a asset that is unfungible, right? Like, people have tried to hack it, people have tried to change the rules, and they haven't been. And so you can buy, sell, transfer, use the Lightning Network with our product. And I think that's a very important part of democratizing this space so that everyone can be a part of it and not just the folks that were the first ones on the bandwagon.
talking about the democratization that happens in Bitcoin, I actually really got a clear idea of that listening to Michael Saylor. And he says, if you want to give $10 million to a child who's 5 and you want them to have it when they're 20, right, or 25, right? So you got a 20-year holding period. How do you do that? Put it in real estate, you got holding costs, you got roofs you got to replace, you got all kinds of things you have to do. You want to put it in stocks, you're still subject to volatility of all kinds. Bonds, you've got volatility, you've got interest rate risk, right, all these other different things. So you're going to have some kind of risk, period, right? But with Bitcoin, anybody can put it on a flash drive, save their seed phrase, and know that that Bitcoin is going to be there. The price of the Bitcoin in 20 years is up for debate, right? But it's going to be there with very little holding costs. So that democratization is really important.
Here, as we wrap up this panel and we're coming close to time, just a quick recap, and y'all fill in any blanks that I miss here. What we talked about on this panel, it seems like legislative opportunity is proof of reserves, that, you know, at the end of the day, something like FTX was spurred by bad actors and bad companies and not necessarily the protocol. That a lot of the legislative issues that we're seeing focused on in Congress right now are actually not necessarily related to Bitcoin because it's been effectively classified as a commodity, not a security. KYC, Know Your Customer, and Anti-Money Laundering Acts need to correspond and work within the boundaries or confines of what a technology is actually capable of. And we need to be careful of trying to apply existing laws and regulations to a technology that might not actually work with those laws and regulations. What else am I missing? As we close out, give your final thoughts. Well, what did I miss?
So, I mean, I think even though they're not directly about Bitcoin, the legislation about stablecoins and the definition of a security are opportunities as well, that what we're seeing from the regulators is not great, and so we have a chance with legislation to make that a lot better. I do have thoughts on some of the legislation that would help make it a little bit more simple and likely to pass. If anybody's working on that, I'm happy to discuss it. But also, let me say, for people here, if you're somebody that's trying to change policy in DC or has a proposal for legislators, please try to make it as simple as possible. One of the things that I'm glad people didn't talk about on this panel is that when I was chief economist at Senate Banking, people would come in and say, like, Bitcoin's gonna change the world and we need to rewrite the whole federal code. It's like, whoa, let me stop you right there. We're not gonna rewrite the whole federal code. Come in with some very specific proposal, and as tailored and specific as it is, the shorter it is, the more likely it is to pass. And so I think if we can, pick out as an industry the things that are most important and have some targeted legislation, I think that we can actually, have some positive changes.
Anybody else? Well, with that, if you want to talk about the specific legislation on the floor, we're actually going to have a fireside with Senator Cynthia Lummis later on. So please stick around to that. We're going to dig into a little bit about the bipartisan Lummis-Gillibrand bill that was introduced last year. We're going to talk about what about that bill has stayed the same, what about that bill has changed this year, and see what legislators are actually trying to do to provide regulatory clarity and a regulatory framework for this industry. So with that, thank you, everybody. Thank you so much. Nick, Amena, David, Sam, Thomas. Big round of applause.
Thanks, Grant.